got no muscle, no hustle, no backbone. I stand alone, not tripping. Just saying, I'm different. Ain't hanging on to the coats.
Well, thank you for joining us today. I have a special guest here today, but before I get to that, this is MrNotAdvice, and nothing in this podcast is an offer to buy or sell anything, nor is it advice, not specific investment, tax, or any other advice. Anything that is said in this podcast is the speaker's opinion only, and by listening to this podcast, you agree to hold harmless myself and any of my guests. And with that, I'm very excited about this. I would like to introduce Mr. White, who is actually a Discord member of mine who I grew to find out that he is a banking sector expert and much more. And, for those of you who've been listening, I have been pounding on the commercial real estate sector that it is inevitable that it's going to feel some pain. I don't know how much. So I thought it would be helpful to have somebody else on who actually knew what they were talking about. So with that, Mr. White, welcome. Thank you for joining me. And would you mind sharing a little bit about your background?
Thanks, boss. It's great to have an opportunity to be able to give back. I've had a lot of people help me in my career, and hopefully I can help a few other people have a interest in maybe a baseline knowledge in banking and maybe even an interest in learning more about it. So
Awesome.
I started my career in 1985, when I got out of college. I started working as a credit analyst in a commercial bank. The bank had a specialty in correspondent banking, which wasn't bank by mail. It was really it was a bank that acted as a banker's bank for families and banks that needed financing and also needed correspondent services. At that time, we were in the middle of a ag crisis, if you remember. And so there were a lot of rural banks that were blowing up between 1985 and 1990. And I happened to land in the business at a time where, from a regulatory standpoint, it was fairly loose and liberal as it relates to making loans to families and groups that wanted to buy banks.
Okay.
And merge them. And I had an opportunity to be able to learn about how they did those transactions, finance some, travel all over significant portion of the United States, and meet just a wide variety of different people. From there, I went to the dark side. I joined another bank after about 5 years and went to work in the treasury and funding department of a publicly traded bank. And
do you still have the stink on you, or is the stink still with you?
I'm working on it. I'm recovering.
Okay, I'm sorry. Go ahead.
There I learned how to asset liability was becoming a big issue. I don't know if you remember the company called Sendero, but they were doing a lot of balance sheet projecting and interest rate risk modeling and things like that. I got in right on the ground floor when that was happening.
Okay.
And with my analytic skills and things, I thought it was kind of interesting. And I proceeded to get my securities license, believe it or not.
Okay. And
went to work for a regional broker-dealer. They pulled me away and worked on their institutional fixed income group for I was up to, I think it was around 8 years, and I got promoted up and through the ranks there.
Okay.
So from there, I took two of our guys from our main trading desk, and my partner and I, and we started our own firm and ran that for 7 years and sold it.
So what are you doing today? You have a broad, obviously. Not only do you have the commercial side of banking, the analyst side of banking, but then you took it over to the true investment banking side. So where did that lead you to today?
So from there, I was on my journey with that firm that was becoming a monster. My boss let me invest in the first de novo bank in the state that I was in about 30 or 40 years. And that was in 1999. And at the time, the barrier to entry for if you wanted to apply for a bank charter was $2 million. And I was one of the 4 original investors in that bank. That bank today is over $2 billion.
That's fun.
In my career, I've helped start 5 banks, 5 community banks de novo. I've raised capital for all of them. I've, as a consultant and as an investment banker, helped turn banks around, help recapitalize them, and there were quite a few I can remember walking into with some of my buddies where we would look at the bank president and say it was a problem bank. And we'd say, have you looked at all these loans? Did you buy any? And they said to us, no. We'd just walk out.
Wow.
So I've been through about 5 or 6 different credit cycles, some bigger than others. I mean, when I first started out, there were bankers who were committing suicide. Things were so bad.
I guess my question would be, of all the banks that you have invested, raised capital for, or personally owned, how much of the banking business did they do that was in commercial real estate, specifically office space?
Not so. There's a difference between owner-occupied and non-owner-occupied. None of the banks that I have invested in, or the one that I'm working in now that I'm running, are in non-owner-occupied in concentration. With the non-owner-occupied that I would be involved in, and some of the other banks that we're involved in would be like apartments.
Okay.
Right. But office, it's from our perspective, it's really speculative.
Okay. So let's continue to talk about that. And then let me also ask you this, because we know that, and you can speak more intelligently to this than I can, but a lot of the paper that's out there, especially in the CMBS market, hasn't been mark to market forever. I mean, they're derivatives. Do you all package up your debt and then sell it off, or do you just sell it off to for servicing? Or
there's a variety of things. I would tell you that on the you got to make a distinction between the largest banks in the country, super regionals, and then community banks.
Okay, let's do that.
And the way I would make that, so when I talk about a banker, I'm talking about a commercial or community banker, not an investment banker. Let's just get that straight first. And I'll also tell you that the character and nature of 99% of banks, it's a noble profession. When I'm talking about these bankers, most of them are really good people. They're very community focused, and they're out to make a buck. But for the most part, it's an industry that I trust my capital with because of the character of the people that are involved. They're all trying to do really well, and that includes their regulators, by the way, too. These types of banks and their nature and purpose, they all serve a nature and purpose in our country. It's amazing. There's people who say, well, too big to fail. If a bank like Bank of America is operating with too much risk and, they need to be put out of business, or technically they're out of business, let's say. I'm just using that as a proxy. I'm not saying that. There's people who are in our country who would say, we'll just fail the bank. I don't think the people who say that are uninformed. Okay. About and rightly so. I think in the last banking crisis that we had during the mortgage crisis, those players who took extreme risk were not eliminated from the business, and the banks could have stood. But the way our too big to fail banking regulation as it is today, and I can make some clear distinctions for you why it still exists today that are black and white. The component that they're really missing, and if I can connect with people in DC when I visit with them, is that they really need to fire the people who are taking excess risk, not eliminate the institution. And I would make that distinction. So when you look at the banking business, we have these very, very large banks, the top 50 banks in the country, and then you have super regionals. And the way you would look at a super regional would be a bank that covers a large sector of the United States or a large specialty in the United States, but they're not. The octopus isn't all over the country. Okay. And then a regional bank can be very large, but they're limited to a geographic or a business line, but they're smaller. They would go all the way down to $2 billion. Okay. And then below that, I would classify those as community banks. That would be up from $2 billion to zero, or to, I think some of the smallest ones today are around $40 million. I will share with your listeners that a bank that's $200 million or slower is probably going to go into extinction because of the cost of cybersecurity, infrastructure, regulatory compliance, those sorts of things. You just can't make enough money at that scale below. It's sad. You wish you could. I wish we had scaled regulation and we didn't have cyber criminals and things like that, but that just doesn't exist, and that's not the world that we're heading into in a digital age. So.
Did you say 200 million in deposits or 200 million?
200 million in total assets. So that would be about 20 million in capital at a 10% cap rate and about 190 million in deposits. And then if you applied 90% loan to deposit ratio, and that bank probably has 170, 180, and they probably carry about 20 million or so in cash and securities. There's some banks that operate at lower leverage ratios and that, like in rural areas and things like that. But for the most part, in order to be profitable, and unless you're operating on baling wire, it's pretty hard to be compliant and state of the art and operate with efficiency ratios that are really low and not make any loans. You can't run a purely investments bank and not make any loans. Pretty, that would be foolish.
Have we seen, Mr. White, though, sort of the cherry picking on these small banks that you're talking about in terms of being acquisition targets, or do you see another wave of acquisitions?
So unfortunately, I think it's just going to continue to consolidate until the nature of the community bank changes. One of the things we celebrate when I meet with other community bankers is that we are truly on the main street. We are at weddings, funerals, bar mitzvahs, parties. We drive up the driveway and our neighbor is our client. And when I mean that, I mean they can be 40, 50 miles away and be a client. But we know each other. We know our families. Our client base is very diverse in terms of race and creed and all kinds of ways you can slice and dice. You know, the nature of the community bank is, if you watch It's a Wonderful Life, is really a stupid, simple way to do it. But I'm telling you, it's a good movie to watch because it makes you understand exactly the nature of the community bank. And what we are is community banks really provide liquidity to the local community. We saw that really shine during the pandemic, where the very large banks, don't get me wrong, large banks serve a vital purpose in this country, and I can talk about large banks and how greedy they are all day long, but the reality is that all those different sectors that I mentioned in banking business really serve a vital interest for our country. During the pandemic, we had potential clients coming to us that went to a large money center bank for their PPP loan, and they didn't know if they had a PPP loan. They did an automated application. They didn't know if it was in process. They never got any communication. Whereas at the community bank, they knew exactly where they were at. I remember in the first phase of PPP, I was talking to legislators in Washington, D.C. who were on the Small Business Committee in the middle of the night, later than we're talking right now. I'm giving them feedback about how the process and the systems are working and how they're not in the program, because they stood that program up in about 3 weeks. You know, that the SBA gateway was really bad, and the SBA was way behind the 8 ball on technology, and it was just really a mess. But we got through it, and what the public found out, our bank in our state was the 10th largest underwriter of PPP, our little bank. And when I say little, it's under $1 billion bank. Our team was really proud of that because we innovated, we served our client, we maintained the focus on the idea that President Trump and the administration really wanted to get that money out onto the street because businesses were going to fail. Think about like tourism businesses. Think about businesses that were in the business of providing services to restaurants, airlines.
Well, I was a CFO of a company that served emergency vehicles, and
Right.
I applied for the PPP loan. It was not a small sum, and you and I have had private discussions about how some of that went sideways in terms of what the federal government put out in terms of, they weren't checking anything. They were told, at least in the state I was in. And, but we paid it back within, I think, 9 months. But we needed it. We needed it because we couldn't stop working on the emergency vehicles because they were needed then more than ever. So we couldn't just stop buying parts and everything. So that was one of the first things I did was establish a relationship at a super, a regional, and then a community. Because all three of them had different levels of service, and really they were focused on one area. So I guess what I'd like to ask you is, I'm really curious, are you saying that from your perspective, the community banking sector itself will be largely insulated if a CRE event happens? And secondly, do you think a CRE event would happen sourcing or starting out of the banking sector?
That's a loaded question. I think that no, there are not community banks who are protected from CRE. everybody says it's going to be different next time, and I think there are some aspects to the next banking crisis we'll have. Disintermediation has occurred in banking on a wide scale in a variety of different ways.
Let's define that.
So disintermediation is where a provider sees a client need, so a customer need, whether it be commercial or individual, that financial institution is not satisfying, and that need could be save me time, save me money, make me money, increase my ego. All the 5 things that you sell to somebody when you sell something. They're the benefits, right? And this gets into a little bit of understanding. Remember that a bank is really a regulated hedge fund. Okay. So its activities are limited by regulation. Why are they limited? Why are they regulated? Well, they're regulated because the bank has a charter, and that charter grants them the ability to be able to go and issue debt deposits that are insured by a fund that is backed up by the United States government, and they are able to offer the rates on that debt because of that backstop at rates that are equivalent to where the U.S. Treasury fund. So, in a backdoor way, it's really subsidized money. Because of that regulation, there are limits as to what a community bank can do in the payments and the credit stream. And those are the 2 big moats that a community bank has, or a commercial bank, and even big banks have, is that they have a regulatory license that allows them access to a proprietary payments network, and they have a license to be able to collect deposits and make loans. Disintermediation happens because, one, they aren't making those loans or taking those deposits in a more convenient and faster way. And when I'm talking about that, you can think about it from a consumer perspective, but you can also think about it from a commercial perspective. From a commercial perspective, think of Goldman Sachs going out and offering a CDO and to private credit group, and that private credit group is out making commercial real estate loans, and they're doing deals that are anywhere from 5 million to $1 billion, and so that's where the disintermediation occurs. And so we see a lot of that kind of activity being undertaken in different regions. So you have someone from New York coming into a marketplace, and they come into the marketplace and they perceive that there's a price opportunity and a credit opportunity without local knowledge. It's like Bank of America coming into a community and opening 10 branches and thinking that they're just going to conquer the community and they know what's best, and they hire a few local stooges, and all of a sudden what they find out is 5 years later they're closing all of them because they didn't take the time or invest in the local market knowledge enough, or they didn't take a longer term view in order to get into that market. Well, the same thing happens in these large deals. You've watched the show Yellowstone, and the Madison Capital comes into Bozeman and they start pushing people around. So in the community bank arena, what we do is we participate banks between banks. And some of the bigger ones use what's called the National Shared Credit Program, which are credits that are over $25 million. And in my experience, when you're involved in a transaction, those sorts of transactions where there's 10, 15, 20, 25 banks and their credit goes bad, guess what? You're paying the investment bank that put it together to work it out.
Right.
And you really have 1/25 of voting rights. So as an organization, the way we participate credit and the way we create liquidity and mitigate credit risk is we work with up to 2 or 3 other banks to give us a force multiplier, and also to give us the ability to be able to get together with those banks with the client if we have to resolve an issue in a manner in which we don't put the client out of business, hopefully.
Almost like reinsurance.
Almost, kind of.
Yeah, sort of like spreading around.
What you're doing is you're spreading the risk around. Yeah. So
Well,
it's very much like that.
I hate to put you on a hot seat, but
Sure, put me on the hot seat.
Yeah. So, and I want you to speak frankly and forget who you're talking to. Do you think that MrNotAdvice is crazy for being out there saying that risk is at a level within the commercial real estate sector that is perhaps unheralded, at least in the last 30 years, and that banks today are in worse financial shape, than they were 2007. And even worse, derivatives have grown by a factor of 7. So am I wrong or do you agree or disagree that the CRE space is headed for, we don't know how hard of a fall, but a fall, and that it's going to hurt banking?
So there's a lot of questions in what you said, and we have to remember what I said about disintermediation. I do not think you're crazy in saying what you're saying. I think the commercial real estate market is way overdone right now, way over leveraged. And the risk has been offloaded to people who don't understand the risks that they've encountered. Because that risk isn't, the people who are managing that are not managing their own capital and managing some. So that's the answer to your first question is, no, I don't think it's overblown to make that call. What I can tell you on where I would challenge you on is I don't know what the timing of realizing the cataclysmic event or it's a staircase up, it's an elevator down, but that elevator might go a little sideways.
Yeah.
When the way a financial crisis evolves is that it slowly mutates like cancer would metastasize in a body until somebody calls it cancer. And then all of a sudden, the elevator goes down really fast. And if you remember the last banking crisis that we had, it wasn't until Hank Paulson under the Bush administration called out the fact that the liquidity markets started locking up, banks started pointing at each other, the kimonos were open, and when the musical chairs were going, there were a few banks that couldn't find a place to sit down, and they failed. And then all of a sudden it created a domino effect. And that's when that elevator down happens really quickly. Now, the second part to your question that you can ask me more questions about is, I don't know that it's necessarily all in the banking business because of disintermediation.
Private equity, hedge funds, insurance companies, pension funds.
If you look at, so I'm going to call out some companies. I'm sure they're all run by good people. And I'll share a few things that I've been doing that I have intimate knowledge of from the standpoint of what's publicly available. But you look at OPI, Office Properties Income Trust, their stock's trading almost at $1 today. Their debt is trading at, I believe it's around 14.59% was the other day. And that's a REIT. So, and I don't know what that means I think creditors are smart. They're smarter than they were last time around. And there's been a lot of innovations in debt structures to protect. In the last debt crisis we had, there was a lot of structures that were in place that actually destroyed deals. In other words, you had trustees that didn't have power to make rational decisions. They just had to act like robots. And market participants like myself and others took advantage of that. And the unfortunate part of that is if you had someone who actually had power and was in a rational seat to be able to make decisions and work with borrowers, that the outcome probably would have been higher. Instead of 10 cents on the dollar of buying the debt, you were probably buying it in the 30, 40 cents range.
Well, let
me
ask you this, though. In those types of situations, that's not been fixed. We still have, right? It's gotten worse.
No. I think it's worse because of speed.
Yeah, and also I think the bad behavior was encouraged. It was never punished.
It was there. Amen on that.
Right, and we can talk about the moral hazard of removing Glass-Steagall and just the mess that created. And then we can talk about CDS. But at the end of the day, I'm amazed that community banks have resisted the siren song, because I know there are many regionals, local banks that did not, and that got involved in derivatives, in commercial real estate. And the problem is they don't understand their product. Like, I've talked to other bankers who they truly don't understand what they have. What they tell you is what they were told by their Goldman or their Nationwide or whoever it was that came out and had this bright idea for them. But I think it's more endemic through the industry. And as in terms of, you asked, what the timing, you're absolutely right. I've called the timing wrong once on a trade. I've lost money on it. But I guess that leads me to this question is, they've been extending and pretending, and they can do that forever as long as, they literally could do that, because all they're doing is tacking on the additional term at the end and the interest with penalties and all of that, but they don't want to book that loan as non-performing, right? Right. So how long they can get away with that forever, right, Mr. White? Or not?
They can get away with it for a long time. So you're absolutely right about and that's what I mentioned real early on in our conversation, is that the people who are taking risk are really the senior managers who are really taking the risk and accepting the risk are the ones that should be taken out of the business. You can cry all you want about FINRA and the fact that it has licensing and things, but the beauty of the way their licensing regime works is that if you have a bad player, you can kick them out of the business. In the banking industry, we don't have anything comparable to that. And it's always been a mystery to me why in the banking business we don't have the ability to do that. Really what ends up happening is you really get kicked out of the banking business by the FFIEC or the Fed,
right,
or the FDIC in their system, and you have to really be a bad player to get but I don't think we've ever seen anybody in a really, really big bank like Bank of America or
no,
JP Morgan or something like that ever have that happen to them, unless they're embezzling money and it's obvious. But for excess risk, I've never seen any of those folks, and I think that's the problem. The way you stop that kind of activity is you put those folks out of business. You don't put the bank out of business. You put the people who are causing the problem out of the business. These banks, a bank is just a regulatory charter, capital, deposits, and then the people that work in that bank. And the people that work in that bank are taking risk, and their board of directors and their regulators are overseeing that risk. And the banks that we have seen that we saw fail 2 years ago, the Fed wasn't doing their job as their regulator. And the first line of defense is that management group is self-regulating. The second line of defense is their auditors, their internal auditors. The third line of defense is their board of directors. The fourth line of defense is their regulators. If you get to that fourth line of defense and it fails, that bank can take so much risk, it's not funny. And that's exactly why in disintermediation right now, fintechs are frustrated because they can't get banking charters. That's exactly why they aren't getting banking charters, because they have no respect for those lines of defense for the most part. All they're trying to do is find ways around it and manipulate it instead of respecting it and understanding why are those guardrails put in place. And they're put in place in order to protect the integrity of the banking system, the confidence that you and I and your listeners have, and the confidence and trust that we have in the banking system. And to the extent that you let bad players operate within that system, you deteriorate the trust and confidence of the people who deposit money in banks.
But I think that the problem is not, I don't look at it as necessarily the number of banks that are the problem. It's that there are such a small number of banks controlling such a massive amount of assets, right?
Yeah, the top 10 banks probably have 97% of the deposits in our country.
Right. And then we look at the notional risk of their derivatives portfolio, which I don't know, is it 7 trillion? I forget the number now. It's enormous. Number. Right. So I understand the argument. I do agree that the majors play a significant role in our banking system in that they're able to offset government risk to private investors much more quickly and efficiently, right, than the U.S. government on its own. So I think they provide necessary liquidity. Now, we have the largest banks have really put the rest of the banking system at risk, I think, anyway, and our economy. I just don't know how bad that risk is.
There's two different kind of bankers. There's those bankers that, and they both have some problems. There's bankers who make the day they make the loan, it's a good loan. All right. And these are good people who really believe in what they're doing. And then we also have bankers that are simply unloading the risk on unknown consumers. And it really could be criminal. And when I say consumers, I don't mean just the consumer, like the consumer that would buy an annuity or buy a deal that somebody synthesized. I'm talking about consumers that buy sophisticated commercial deals, and they still don't know what they're buying. Those are the folks that's one sector of folks that you want to get rid of, and that shouldn't be in the business, and that have no place having access to capital. Unfortunately, when you put Goldman's name on it, or some big bank, Morgan Stanley, some big bank's name and brand on it, it all of a sudden has some gold seal on it. That means that it has the highest integrity and that it is something that it should be bought because it's liquid when it's being issued, only to find out 5 years later that it's at the bottom of the sea.
Agreed. I mean, what entered the banking system, unfortunately, was greed. Seriously. Banking used to, at least, I mean, my relationships in the past, I've had what you say about community bankers. I mean, it was a phone call. I need a loan for this, or hey, can you give me a workout on this, right? Or I'm looking at this property. What do you think? I'd even ask advice on deals, and you're not going to get that at major. I mean, shit. The other day,
At a major, they're gonna, if it's big enough, they'll compete for you with the deal, even though you came to them asking for help.
Well, I was going to say at the major, I'm going to be switched from a intro banker to a senior vice president, who then is going to have to go to a loan committee. Whereas with the community bank, I just go to loan committee. He is the loan committee. It's him and two other people.
I'll even best you on that. At the bank I work at, there's 3 executives and I that can make very conservatively sized loans. We don't even have to go to, we are a loan committee. And then certain loans that are above a certain size go to our board of directors, but we can look at those, we can review those digitally and approve them digitally so that a client like you would be able to just say, yeah, we got it done. Let's go get it. The hard part is getting it all booked and getting the deal done.
Well, unfortunately, though, Mr. White, with the progression of technology and the desire to be more efficient in everything in life, and cut costs, I don't see almost like community banking become like a higher end, almost like a private banking, I guess, because these majors and the regionals will be bought up eventually, and the super majors will continue to grow.
The perfect balance in a community bank is where you have the warmth, competency, sense of belonging, and results in mixture with the digital convenience. And as community bankers, if we can figure out how to keep the warmth, competency, sense of belonging for everyone in the community there and present, but be able to offer the services that we offer in a digital format. I know I'm in the older part of the generation now, but when we're visiting with young people, they really don't want to talk to somebody at the bank unless they have a customized need or there's a problem. And if they have a customized need or there's a problem, they damn well want to talk to a human being. So we have to be ready to find that right balance between being able to customize something and also being part of somebody's life when they don't want us there. And that's a delicate balance. And I right now, that's this thing we're struggling with in our banks is how do we find that balance? Because to be completely analog right now is almost elitist. It's inconvenient. You don't want to walk into the bank with a stack of 20 tax returns and a personal financial statement. You in the middle of the night when you're thinking about a deal and you want to send it in, you just want to send it in a secure email and have it get approved.
Right.
So I think that as bankers, and this is true in any size bank, we need to be ready to adapt to those needs. One thing that would be really interesting for your audience to understand is that our regulatory capital in the banking industry is very defined. We don't have room for goodwill. It's a deduct. So the regulatory capital that will has to be very, very tangible. I say that facetiously because we'll have a conversation, or we can maybe do it on another podcast sometime, about securities valuations and securities marks versus capital. But why do community banks partner with fintechs? Well, we partner with fintechs because we can't blow capital the way they can. And so what ends up happening is the constraints that we have as a regulated entity don't allow us to aggressively innovate, because if we do, we lose money. And we don't have capital that's set aside that doesn't get a mark for us to just go wild with and be able to hire programmers and do all kinds of fancy apps and create the next PayPal or whatever. All that gets done outside the banking industry. And if you think about it, like folks like you or I and other investors, when we put venture money into a company like PayPal in its infancy, we expect that team to blow it. And we expect them to blow all that capital, and we expect them to come back for more. And we give them more because what they're creating disintermediates the payment system. And we really believe in it, right? If you're in a community or regional or even a super regional bank, there's only a limited amount of that activity that you can do before you run out of capital. And so in the banking industry, you asked me about consolidation. That's why consolidation will happen, is it'll happen because the smaller banks don't have that innovation capital to be able to. We have the technology. We run our banks with the same technology that big banks have. We just don't have all the programmers on staff and all the customization that big banks have, so that when we want to modify something, we want to roll something out, or we have a product that we're creating, there's not enough efficiency in that community bank or that regional bank in order to be able to do that on a proprietary basis. We're on the same system as a regional bank. We pay for all that infrastructure. I personally, politically believe we need more banks and less barriers to entry to the banking, and we need scaled regulation. Scaled regulation means that the threshold isn't 200 million, the threshold's 50 or 25 million, or that you or I could go start a bank and serve a local community, and it will serve and just start the whole process over again. Sure.
Mr. White, that brings me to a question. I wanted to circle back. You had said earlier about the different classifications of banks, and obviously, as you've laid out, community banks meet the same stringent requirements, and even more so because they're limited in the type of business that they do. But which class of banks do you see, if any, at most risk for the CRE, and what is the current situation where we're at today versus a normal situation, I guess, a normal environment, or 2007?
We're very early in the time where CRE is going to affect the banking business. So we're in the early innings right now.
What do you think? Are we talking years early?
Don't hold me to this, but probably in the next 24 months.
Okay. Right.
The issues that we ran into in the 2006, 2007, 2008, 2009, they took about 24 to 36 months to manifest themselves. And that happened very quickly because it was consumer-based. I think when you're talking about CRE specifically, I think those dents have started.
Okay.
What we're seeing in major metropolitan areas is very, very large buildings that are, the debt is owned by CDOs or insurance companies or pension funds that are trading at cents on the dollar below 10 cents. And I don't think we've seen those cracks ripple in a major way into the banking sector yet. We are starting to see it, though.
And in which class of banks will there be a specific subsection of the banking sector that gets hit first? And I know you said that outside we have private equity, we got pension funds, insurance, maybe some sovereigns, but within the banking sector itself, is there a different or specific size that you're looking to?
I think it's going to be in the regional and super regional banks. And the reason why I say that the biggest banks in the country have more sophisticated models and access to the capital markets in ways that they can offload that risk. And their liability probably becomes more of a legal liability than a credit liability. When you get into the super regionals and regionals, they don't have the ability to lay a lot of those risks off. And that would be publicly traded banks and private banks that would be involved in that mix. I've got a few that we can talk about.
Okay.
That I've done some research on. I don't want to pick on banks, but we also have to recognize that this is all public information. So.
And while you're doing that, let me ask you this question. What are some of the cracks, so to speak, in the foundation that you'll be watching for? Are we looking for a continued rise or a reversal back on the 10-year or the 20-year? Are we looking for the strength of the dollar? Are we looking for specific debt metrics coming out of the industry itself in terms of debt ratio and all of that? What are you looking for?
I think the first thing I'm looking for is a liquidity market to lock up.
And how will that show? Well, I mean, if you're one of the listeners and you're not a person with decades and obviously you have banking experience, what would you look for?
You're going to hear about funds that blow up or funding issues, or you're going to see spikes at the secondary and tertiary funding sources for these banks that dry up. And so you're going to hear about it because a fund blows up here or there. You're going to hear about it because it gets out that some bank is at a stressed funding from the discount window or alternative source like the Federal Home Loan Bank, or that their lines are getting shut down.
Okay.
You're gonna it'll be really subtle, but the institutional markets, when they see that stuff lock up, it flips them out. They wig
Okay.
out, and when they start wigging out and they start talking about it, it accelerates.
Where the F were you about 9 months ago when I did my Bank of America short? Thank you, Mr. White. You weren't here yet, I know that. But no, this is very good. I mean, look, listeners, I got a Bank of America short. I've been picking on Bank of America because I think it's an atrocious bank. I think it's atrocious almost at every level, at their branch level, all the way up to the executive office. However, I could stand firm and be proud and say, I'm going to be right and stick with it. I'm taking what an expert says. I'm going, well, he's saying regionals and super regionals. Okay. I need to look at those. Now, the good news is I've position sized my Bank of America position where if it goes against me, it's not going to kill me, right? It may leave a minor scar. But even I, with over 30 years trading experience, when somebody knows what they're talking about, listen to it. Use it as assimilated into your trade methodology and decision making.
You've given me a lot of advice. I'll give you a little bit of something to think about.
Well, technically speaking, for our listeners, I've never given you any advice. I've only offered ideas, correct?
Yes, thank you. Yeah, and
Thank you, sir.
You've taught me a lot. You've taught me a ton. You've forced me to teach myself based on asking me questions.
That's very kind of you.
Yes. So shorting Bank of America into a banking crisis is something that you would want to do in terms of generally following the crowd into a funnel into
wait
a
till the dam breaks.
Yeah, right.
Yeah, don't try to be early.
Because
which is what I'm trying to do, by the way.
Bank of America is never going to fail. I'm going to tell you that right now, just politically.
No, but I don't think their stock price is going to be. I think their stock price will take a haircut. But yes,
yeah, I think I would short the stock all day long, but going into the funnel, and that's when it's already happening, because every bank will get thrown into that, boss.
And please, listeners, understand. And I know Mr. White understands that when I talk about shorting Bank of America, I have a very defined risk metric to it, and I have a very specific position size. So also my time frame. I'm using options. I have a lot of experience doing it. So it's highly unlikely I'll be taking 100% loss on it. Plus, I have Mr. White, who I can go talk to.
Well, it'd be better if you missed the trade than if you lost a lot.
There you go. That's right.
So let's protect the capital. The other thing I would do with the banks is, especially with someone like myself, is it's really easy to get emotional about a bank. Well, that's a bad bank. I'm going to buy puts on it. That's not a reason to do it. The reason to do it is when that bank is trapped. And that bank is, remember what I mentioned earlier, is that the bank is a regulated hedge fund. Well, think about the auspices of a hedge fund. A hedge fund is a little bit of capital and a lot of debt. And in that scenario, when you have a certain amount of those assets that go bad, that thing is going to fail. And that's true with any bank. Watch It's a Wonderful Life, and you'll understand on the ground level. And then you just add a whole bunch of zeros to the little town savings and loan, and you've got Bank of America. When the banks that we saw fail 2 years ago failed on a lack of liquidity. And they failed on a lack of liquidity. And so when you ask me about how it's going to happen, and I don't know everything, I don't have a crystal ball, but I have a suspicion. When you can have the biggest net worth in the world, if you don't have liquidity, you have zero net worth.
Yep.
Okay? So that's true for banks too. And with Silvergate, which self-liquidated, and the other banks that had that went down, they had digital runs on the banks, and those digital runs happened overnight. I remember one of the banks, we had a client that had all their deposits with them. And on Friday night, they thought their technology company was out of business. And by Sunday afternoon, I gave them a call and told them that they were to get rescued. And that's what I mean by an uneven playing field, because we have banks today, boss, that have failed in this fall. There were two banks that failed, and the depositors who had in excess of $250,000 got zero.
When Silicon Valley Bank failed, I had still do, a friend of mine has a hedge fund, actually PE, down in Texas. And I called him about a week later. I said, hey, how you doing? So generally joking around, he goes, I'm not doing well. I said, what happened? He goes, my whole book, we have all of our accounts in Silicon Valley Bank. I go, what? Why? I mean, you're not even located in there. He said, access. It's access to the board that was there. It was access to all the other companies. I forget. It wasn't Snapchat. It was a reasonable size company, tech company that had their entire payroll there, and it wasn't insured. They never insured. I mean, it couldn't be insured, obviously. And so it was shocking to me and you must be shocked every day, it's just the sheer level of incompetence. Like, who lets them have their account at a bank where it's not insured? But then you obviously heard more of the story. Well, they were getting some sweetheart loans and it was helping the bank out and all of that. But
Silicon Valley offered a full vertical cap stack to a startup.
So let's explain to everyone what that means.
So if you went into Silicon Valley as a startup bank, they would offer you a debt. They would offer you subordinated debt. And once you got your model going, they would offer you equity. And they'd offer you all kinds of different services in a vertical stack. So the point being is that it's like Apple with your iPhone. If you've got all your music on it, you're locked into them.
Like an ecosystem.
Well, they locked you into their ecosystem. And their access and their network for all kinds of different services. And it was really an incestuous bunch. And that capitalism, that's one of the bad things that happen in capitalism is they find each other. They create an ecosystem. That's the bad part of capitalism, if it's not regulated and controlled. Well, the Fed was not acting in their supervisory capacity over that bank. And you can go read the reports on it. And the Fed in California would tell you that's not true. And I would say that's why they were a state chartered bank as a Fed member. So their regulator was not the FDIC, it wasn't the OCC, and it wasn't the state banking department. The only regulator that went into that bank was the Federal Reserve in California.
Yeah. And
fourth line of defense that
who was on their board? A Federal Reserve member that was in charge of that region. I mean, what a terrible idea. You put the regulator, I was telling somebody the other day, it was like when Drexel, Burnham Lambert, right? They went to the SEC and said, hey, we got this great new product. It's called a mortgage-backed security. It's a derivative. And the SEC looked at it after about 6-9 months of putting their fingers up in the air. They went back and said, we don't understand it. You guys regulate it yourself. I mean, what a brilliant idea. We're going to take a product that is new. It's engineered. Okay. It's complex. It's got a ton of moving parts. And we're going to let the guys who created it regulate it. Also the guys who will make the most money off of it. And then we wonder why they sold all that crap, because they all made the money on the front end. But anyway, I digress.
So now you asked me a question about where the opportunity might be. Let's talk about that. Yeah. Let's talk about a bank in a vacuum, and let's pick on a bank. Okay. And the reason why we'll pick on the bank is because it's a good example of where your listeners can go to look for other banks that might be like it. I don't think there's another one in the country right now that has as severe problems as it does.
Is it Bank of America?
No, it's Flagstar. Flagstar, FLG.
Flagstar Bank. Is that an Arizona bank?
No, it's the old New York Community Bank.
Oh, it's the old New York. Okay. So
Steve Mnuchin and his group are in there.
Okay.
So they bought Silicon Valley Bank. And here's why I think it's a good microcosm of the problem. One, they have a securities portfolio that's way underwater. Two, they're in the CRE business. And they have they're on all the lists of database data that I did to provide data for our discussion today they come up on the list a lot and they get flagged. What I will say about Flagstar is that Mnuchin and his group have a lot of capital, and the gentleman that he put in to operate the bank was very high up in the I believe it was the OCC or the FDIC. And on the safety and soundness side. So these are individuals. I mean, Mnuchin used to be the Treasury Secretary, and I can't remember his name. The gentleman that's running the bank was the head of safety and soundness. I believe it was for FDIC or the OCC. So these are people who are not only politically connected, but they also understand what they're doing and understand that the risks that they've undertaken. What I will say to you is my eyes roll back into my head when I look at how correlated trading is on that stock relative to where financials go in general, because they appear to go in lockstep, but the risks aren't the same.
Before you get ahead of yourself, what's the symbol? You know?
FLG, I believe. Let me look here. It was NYCB, but I think it's FLG. They just changed it. FLG, Flagstar Financial.
Right.
So I think that's one if I were you, I'd put that on my radar. I've watched the options market. It's not that liquid. And I also think they're doing right now, there's because of the amount of capital and the sophistication that's in there, I think they're doing some hokey pokey, but, that's a suspicion of mine. I'm not saying that for a fact.
You know, you could tell me I'm a conspiracy guy. I think these guys effectively mentioned, and wasn't the former Kmart or Sears savior involved too?
I don't know.
Yeah, I think he's involved too. He's involved in Munching Group. But here's my question. Are they setting this bank up to fail just so they can be bailed out?
I don't know. I'm trying to figure out why his group would take that risk when they could just go charter a bank and or go acquire a bank with that capital and get the qualified people in there and probably just really tear it up and rip it up.
Yeah, but certainly he has the connections to get a bank charter, right? They got a lot of business in rent control.
Mm-hmm.
A lot of business in rent control. And for those of that you don't know, rent control means exactly what it sounds like in New York City, where you literally can't raise the rent as an owner. And it doesn't last a year. It lasts decades sometimes. However, the problem with it is for the operators, if the costs go up, they can't adjust the rents up. And guess what's happened? Property insurance, taxes, just those two alone, right? Then you couple that with maybe declining property value, declining rents, or declining occupancy. So am I getting just the basic thesis? You know, New York Community Bank's got a problem. Their book of business stinks, and that's what you were talking about, the securities book. So they're in a very special type of lending, right?
Yes, and the other thing that stinks about that is they also have all that cash flow from those deposits. So if they've got stinky assets and they get rid of it and they lose the deposits, it creates a funding bind for them also.
I just can't figure out why he bought it. I'm sitting here, why would you buy that bank? Why?
I am too, and there's got to be a reason or something that they see there. Now, maybe they did a miscalculation, which is easy to do, but sometimes you look at something and you go, God, I can't wait to buy that, and all of a sudden you buy it and you go, what did I do?
Yeah.
And I would imagine that there have been a few conversations like that.
I think Marcus Lemonis feels that way about Beyond. He's going, what did I do? I should have stayed on TV where I was the fixer. Now I'm going to be known as the former fixer.
Would it be interesting for you and for the listeners to know a few specific names as far as risks? Okay.
Yeah, let's do that.
Let me throw a few at you before we run out of time.
Let's first of all, let's title these. What are we looking at here, sir?
So a couple of things that I want to give you some data points. So I talked about a liquidity lockup creating a problem where the first cracks are. Okay. There's already cracks in the business too. And so let's get to CRE, but let's start with the securities portfolios of some of these banks in our country.
Okay.
So banks by their charter have to hold a certain amount of securities on their balance sheet. They can't make all loans with it. And those securities are supposed to act as a earning asset that's a backup funding. So this liquidity lockup can happen, and the only securities that are liquid are securities that are either at par or at a premium, because I don't know of many banks who are willing to take losses on their capital in order to get liquidity unless they have to. Okay. Which those 4 banks that failed 2 years ago, that's exactly what they had to do, including ones that didn't fail. There were the 4 that failed, but then or one that self-liquidated, 3 that failed, but there were about 10 other ones, if you remember, like PacWest and First Republic, that they didn't fail, but they had some really serious funding issues. So in our country right now, publicly traded banks that have the highest percentage of held to maturity and available for sales securities in combination are these. And what I mean by available for sale securities are securities that we have to mark to market every quarter. And they show up on the call report and our capital is deducted for them. Okay. So, which is fine. That capital represents itself from a book standpoint in the right way. The held to maturity securities don't, because the banks that hold held to maturity securities don't have to take that mark. So these banks could be zombie banks. If they have enough held to maturity depreciation, those are not problems. You and I both know from being in the capital markets, those are not problems that go away overnight if they're long duration assets.
And for those listeners who have listened to me before, what he's talking about is all the crap of derivatives.
Yes.
A lot of it, right?
Yes.
Because let me ask this question, Mr. Wright, as a quick aside. Do they have any idea what the real values are?
No.
Exactly. They don't
They
want to
don't.
know, do they? They really don't
Well,
want to know. It serves their
it takes
benefit.
a willing buyer and a willing seller to create a
There you go.
market, right?
Yep.
And if there's no willing buyer, there's no market. So they're not liquid. So the one with the highest in the country is SFNC, that's Simmons Bank. 15.81% depreciation in
And
their
what does that mean?
securities portfolio.
So that means
Well, that is $1,061,000 of depreciation as a percentage of their total securities.
and they had to
When
take
you
that
have a
why?
15% mark on your securities portfolio, you got a really serious problem. So I would watch them. I would watch South State Bank, SSB. They have about 13%. I would watch Eastern Bank, EBC. I would watch Commerica is a good one to watch because that probably has a deep market for equity. Wintrust, Bank of Hawaii.
Really?
Yep. I would watch WSFS Bank. That would be WSFS. And I would watch Santander Bank, BSAC.
That's a Spanish?
That's Puerto
Banco
Rican, I
Santander?
think.
Yeah, right?
Right. The others are Ally Bank, ALLY.
Mm-hmm.
Independent Bank in Texas, IBTX. Remember these names because they're going to come up when we talk about CRE too, which is the double whammy.
Hey, the Independent Bank is who I got the PPT through.
Yeah, they're a great bank.
Yeah, they
In
were. They
Texas.
got bought out. They just bought out a bank in Colorado. They bought out Guarantee Bank and Trust here in Colorado. Okay.
So just all I'm saying is keep an eye on them because they have depreciation in their bond portfolio, which means you could see a liquidity lockup. Now, who knows how they're hedged and things, but these are things to pay attention to. Truist Bank, TFC, is another one to watch. Old National Bank, which just bought Bremer today.
What are they trying to
Keep
do?
an eye.
Buy assets
ONB.
or buy market?
Buy market. ONB is their symbol, and then Bank of America, BAC, and they're over 10%.
I love Bank of America.
So those are the top ones for securities depreciation.
Okay.
Now let's look at.
Well, I think this is a good place to put a marker in this because I'd like to, I'd really love to have you back, Mr. White, especially with the changes that are going on in our government, Trump coming in, what policy he's going to have. And so I'm just curious about the timing, but I'd love to have you back.
Absolutely. I'm glad to come back. Be a good time as we approach the inauguration after year end. Maybe we'll see some of those cracks start to widen in the fourth quarter.
Okay, because you'll have fourth quarter numbers then.
We'll have fourth quarter numbers at the end of January.
Okay, perfect. I think that'd be a great time. And in the meantime, listeners, look, if you have, this is a great example of the Discord community. And I'm not trying to sell anything because it's free. But Mr. White is a member of the Discord community. And in watching his comments, I will tell you that he is he's one of the highest level experts we have, but he's one of many professionals that effectively what we've done there is built a huge group of analysts. And so who are not beholden to any firm or their paycheck. They're beholden to themselves and a community. So Mr. White's a perfect example. So I want to thank you for joining us. And if you do have questions about a specific bank stock, please email them to me. And you can email that to podcast@MrNotAdvice.com. And if you do that, then I will forward them to Mr. White. And would you be willing to maybe look those over and answer some of them on the next podcast we do?
Yeah, you can pick the most relevant ones, and I'd be glad to try to take a poke at them. All right.
Yeah. Well, thank you, Mr. White, for joining us today. I really appreciate it. And again, listeners, if you do have questions, please send them in to the email. I'll forward them to Mr. White. If you want more information about me, I'm at MrNotAdvice.com. If you scroll down, you'll find information about my podcasts, YouTube videos, and of course, the live Discord. So love to have you there. We have a great community. And thank you so much, Mr. White, for coming on. I know you've been sick. I know we're coming up on the holiday, but this is incredibly useful information, and I'm super excited to dive into it, and I'm super excited to have you back. Did you have any closing remarks, sir?
No, thanks for having me. I'm eager to share more. There's a lot more we can discuss. So let your listeners digest what's going on, and if you want to come back and dive into some more banking things, we can do that.
That's
fantastic. So thanks for having me.
That's fantastic. Thank you so much. And listeners, hey, have a happy Thanksgiving and have a safe Thanksgiving. And thanks for listening. Have a great day.
Oh, my joy, the I pursue. Oh, I'm running for the city. I got the new word in my book.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping. Just saying, I'm different. Ain't hanging on to the coattails of the